So what if I told you that the real key to building wealth, it isn't about earning more money. Nope, it's about changing one simple little equation in your head. Today, we're going to dive into the world of investment management and see how a tiny shift in how you think can unlock some serious financial freedom.
Okay, let's kick things off with a question that probably hits pretty close to home for a lot of us. You know the drill, right? You get your paycheck, you pay the bills, you try to have a life, and then, boom, end of the month. Is there anything left to save? If you're staring at a zero or close to it, trust me, you are not alone. But here's the good news. There's a really straightforward way to fix this, and we're going to get into it right now.
All right, so first up, let's break down the formula that, honestly, most of us just follow by default, probably without even thinking about it.
Yeah, this is basically the default setting for most people's financial lives. We earn, we spend, and then we just kind of cross our fingers and hope there's something left over to save. I mean, it sounds logical enough, right? But this way of doing things has a huge critical flaw.
And here's the problem, the big one. When saving is just an afterthought, it almost never actually happens. I mean, life gets in the way, right? Unexpected costs pop up, and our expenses, they just have this funny way of expanding to eat up every last penny of our income. When you do that, you're basically leaving your entire financial future up to chance. And let me tell you, chance is a terrible financial planner.
So, how do we fix this whole mess? Well, it all starts by taking that formula and flipping it completely on its head. It sounds simple, but this one little change can build a totally different financial reality for you.
Okay, this is the big aha moment. This is the simple but seriously profound shift. Look at the right side of this. Instead of income minus expense, it's income minus invest equals expense. You've probably heard of paying yourself first. Well, this is exactly that in action. You make building your future the top priority before you even figure out what's left for daily spending. This isn't just some math trick. It's a mindset that forces you to live on what's left, which guarantees you're always investing in your own future.
So, what's a good target to aim for? Well, a great goal is to invest somewhere between 15 to 20% of your income every single month. Now, I know that might sound like a lot at first, but when you make this a non-negotiable, a real commitment to your future self, you are putting yourself on the fast track to financial independence. Seriously.
And the payoff? Oh, it's huge. Because this habit, it doesn't just put money away. It puts your money to work for you. Over time, those investments can start generating their own income, creating this super strong financial foundation that basically acts as a shield against, whatever life decides to throw at you.
Okay, so you're on board. You've committed to investing first. Awesome. The next big question, of course, is where does that money actually go? So let's explore a few of the most effective places to invest.
First up, real estate. It's a classic for a reason, right? Physical assets, we're talking land, houses, flats, even shops, they tend to go up in value over time. And on top of that, they can generate a steady, consistent rental income. And that's exactly what we're talking about, creating that powerful new revenue stream.
Another really solid option is government savings instruments, like bonds and notes. These are generally seen as one of the low-risk ways to grow your money. Now, different countries have their own versions, but the basic idea is the same everywhere. You're essentially lending money to the government, and in return, they pay you back with interest. It's a great way to get steady, reliable growth.
All right, now let's talk about the big one, the one area that holds incredible potential, but also causes a ton of anxiety for people. Yep, we're talking about the stock market. It's time we separated the fear from the reality here.
And look, let's be totally clear. That fear is completely understandable. The market does have risks, and there are so many misconceptions floating around. But, and this is a big but, with the right knowledge and a smart strategy, you can absolutely move from feeling scared to feeling empowered.
In fact, for anyone who doesn't have, a huge pile of cash to buy property, the stock market is one of the most accessible and powerful tools out there for building wealth. And the best part? You don't need a fortune to get started. You just need a strategy. So, what's the plan? How do you invest smartly and, crucially, minimize that risk? Let's break down some real, actionable strategies you can use. Okay, it really comes down to 3 key steps. Step 1, choose what are often called A category or blue chip shares. We're talking about big, stable, profitable companies, the ones with a solid track record of paying out dividends. Step 2, diversify. Please do not put all your eggs in one basket. Spreading your investment across, say, 15 or more different companies is a great way to manage risk. And finally, step 3,
Think long-term. This is not a get-rich-quick scheme. This is a 10 to 15-year plan for steady, sustainable growth.
Now, to make really smart decisions, it helps to speak the language a little bit. You'll see terms like EPS, which is earnings per share. That just tells you how profitable a company is for each share of its stock. Or NAV, net asset value. That gives you an idea of what a company is really worth, fundamentally. Learning these basics is what takes you from just guessing to making truly informed investment choices.
Now check this out. This is a really powerful comparison. On one side, you have something like a DPS, a deposit pension scheme. You know, a typical savings plan you get at the bank. But just look at the difference. With stock investments, you have way more control over your money. You have more flexibility to get to it if you need it. And while the returns aren't guaranteed, the potential for growth is just so much higher.
And hey, here's a great little pro tip for you. When you're building your portfolio, try to pick companies whose fiscal years end at different times. So, for example, some might end in June and others in December. Why does that matter? Well, this simple little strategy means you could be getting dividend payouts twice a year instead of just once. It's a great way to increase your cash flow.
So let's bring this all home. The main takeaway, the one big thing to remember is this. By just flipping that formula to income minus invest equals expense, and by using these smart strategies, you stop being 100% reliant on just your salary. You start building new streams of income that create a really tough, resilient financial foundation for the rest of your life. You know, it all starts with that one simple but incredibly powerful shift in your thinking. The tools are out there, the strategies are clear, so really, the only question left is the one right there on your screen. Are you ready to get started?